So, good morning, everybody. I hope you can hear me. Welcome to today's session on innovative financing structures to inclusive financial institutions. I am honored to share this panel today with Edmond Higginbottom and Jerome Peru and Olamide Idun, who will introduce themselves later. My special thanks go out to Ed, who put this group together and had the initial idea for this session. Before I speak a little about what you can expect from today's session, let me share a few things about myself and my role in KfW with you. I think that will also shed some light on why I think this session is really relevant to all of us. My name is Ralph Kastenholz. I'm heading KfW Development Bank's Division for Equity and Fund Investments in Financial Institutions. My team manages around 40 participations that we hold directly in Mfis, in their holding companies, or in funds with around 1 billion euro in assets under management. That team is part of KfW's recently established Department for Global Equity and Funds, which is headed by Jan Martin Witte, whom you might have heard of. The department was formed in summer 2020 amidst COVID. And the aim was really to centralize all equity-related businesses within KfW Bank. Well, as you might know, in the past, KfW has always had a rather niche equity business that has mostly revolved around support to the development and microfinance markets worldwide. But clearly, the mandate and focus of that equity business has shifted and broadened over time. In addition to all things microfinance, we have all things we do in microfinance. We increasingly become engaged in a broad variety of impact investments and blended finance vehicles across different sectors and regions. And until last year, this growth occurred rather decentralized across the entire bank, with equity and funds investments being pursued by more than 17 teams and across 9 regional departments. So over time, it became increasingly obvious that it is incredibly difficult to ensure a coherent approach towards portfolio development in this decentralized setup. In addition, increasing regulatory pressure significantly increased the cost of doing business that way. As a consequence, KfW decided last year to centralize the entire equity and fund investment practice into one operating unit. I would hope that this centralization will allow us over time to get an even better grasp of what is really needed in the financial inclusion space. Our aim is to play here a role to push forward systemic improvements on a large scale, together with our partners and fund managers that we cooperate with. More than ever, we think that a joint effort is really needed to tackle today's challenges. Our vision statement reflects this, as we aim to be a leading catalyst for making SDGs investable. So personally, over the past 14 years, and I have to tell you this to give you a bit of a background, I spent my postgraduate career at KfW, which is surprising for myself, since I always thought that my broad interests would lead me elsewhere at some point. But I had an interesting time during these years, and I moved quite a bit within KfW and worked in project finance, corporate strategy, before I became head of derivatives and local currency solutions at KfW IPEX Bank. That is a 100% subsidiary of KfW that is established as a commercial bank and is supporting the German and European export industry. I moved into the development finance space only slightly more than a year ago. And my motivation really is to bring the things that I've learned from my previous experiences to the development finance universe. And I think that is a motivation that really, I think I share with my fellow panelists, and which makes this session today really interesting. So what can you expect from today? Well, we all know that we need resilient financial systems and capital markets to face the immediate challenges and those that lie ahead. Without that prerequisite, all other ambitions are bound for failure. And in this context, I think that the microfinance industry has evolved quite a bit, to say the least, over the past few decades. But financial inclusion of underbanked areas and systemic risks remain key challenges. Also, large differences in different regions still exist, and especially the least developed countries remain underserved. For inclusive financial institutions, innovative financing structures can help to close the gaps and make financial markets more resilient. This panel today will discuss examples for these innovative financing structures to inclusive financial institutions. And we have Ed here from Verdant Capital, who will contribute to the discussion based on the instruments that will be invested in financial institutions via the Verdant Capital Hybrid Fund, which has a pan-African investment mandate. These include subordinated debt and preference shares, and for regulated institutions, additional tier 1 and tier 2 capital. And that will all help to crowd in senior debt from other sources. We have Olamide here from the African Local Currency Bond Fund, who will discuss in his contribution of local markets how the funding mix can be enlarged by having bonds introduced into the African market. And well, of course, the ALCBF is approaching its 10th anniversary already, and there are a few lessons that we can share here that have been learned over time. And well, TCX also is approaching a landmark of its own, and I'm happy to have Jerome here from TCX. TCX is coming to the completion of its 15th year of supporting frontier capital markets through the provision of currency hedging. And the panel will, of course, discuss the contribution of TCX, both directly and indirectly through spurring competitive FX hedging options. Well, the panelists will discuss the funding landscape as we look ahead to the next years. What are key funding opportunities and what are the key gaps remaining? And with this, it is my pleasure to hand over to Ed, who will share his perspective on the topics raised. But before I do that, Ed, sorry, I have to say you're all welcome to ask questions, and we will try to answer them during this session. So it is a worthwhile experience for everyone. So I would encourage you to do so. And with this, I hand over to you. It's a pleasure. Ed, go ahead.
Ralph, thank you very much indeed for the introduction. My name is Ed Higginbottom. I'm Managing Director of Verdant Capital. Verdant Capital is an impact-orientated investment bank and investment manager. One of the specialties of Verdant Capital is the microfinance sector, or inclusive finance sector, as we perhaps use the term more aptly. Although today we'll talk about MFIs and IFIs interchangeably. What is important? Innovation in terms of financing instruments to MFIs is very important, and the bulk of my presentation will set the scene in terms of why that's important, what are the challenges which face MFIs in Africa, what is relevant elsewhere in the world, and then we'll circle back and talk a little bit more about the specific instruments which we're involved in. I'm just going to share my screen. What do MFIs need in order to grow? If we look at the MIV community over the last 10 years or so, it has grown by about 8-fold in terms of assets in the MIV community, which is about 20%. It's more than 20% per year. So we can debate whether that's due to desire by investors to put more money into impact themes. We can debate whether it's just due to the fact that interest rates are very low and investors around the world are looking for higher yield. But the fact is the MIV funding base has grown, and this money has made its way into MFIs. We can also debate what is the boundaries in the definition of a MFI, in terms of what is eligible or not eligible for investments from this community. And yes, that definition has expanded, has become a little bit elastic, but one way or the other, this capital has ended up in the loan books of MFIs around the relevant parts of the world: LATAM, Africa, India, Central Asia, Southeast Asia. The funding deployed in Africa has grown, but it remained stubbornly underrepresented. So currently, this is 2019 data, about 9% of the MIV capital AUM is deployed in Africa. 5 years ago, it was 8%. 10 years ago, it was 9%. So basically, it's been the same level for the last 10 years. So while the absolute amount of capital allocated to Africa has grown as the sector's grown, that's, maybe that's 20% per year. On a relative basis, it's still massively underrepresented. So why do I say that MIV investment in Africa is underrepresented? What am I basing that on? Well, if you look at the share of the population in low income and lower middle income countries, as per the IFC definition, 26% of the world's lower middle, low income population live in Africa, which means that the balance of the world, particularly Eastern Europe, Central Asia, Latin America, Caribbean, is receiving significant MIV allocation disproportionate to the populations which are in low and middle income countries, low income countries. So are MIVs biased against Africa? Or is it structural reasons on the ground that make MFIs in Africa less investable? So everybody has everybody is welcome to have a different view on the answer to this question. Anecdotally, I would say I don't think MIVs are biased against investing in Africa. You get a good MFI raising capital, raising debt funding, and there's a queue. There's a queue of MIVs who want to invest. And so it's not that the MIVs don't want to invest in Africa. To me, there's not enough good, high quality MFIs that fit the framework. Size is obviously a factor as well. So this is a survey that we performed in 2019, and we asked all of the MIVs in Europe, the US, elsewhere in the world, the development finance practice, the DFIs who individuals who work in the MFI teams, what are the key reasons why they did not do a deal in Africa? What are the key reasons why a deal was declined? What are the key reasons that reduce the amount of capital they deploy in Africa? And investors could nominate more than one. So the biggest factor is NPLs is too high in Africa. That's probably a catch-all that you could say for declining any investment in any financial services company anywhere in the world, MFI, bank, or anything in between. Interestingly, solvency or capital adequacy being too low is the second most important factor. And anecdotally, we've seen a lot of comments from the market, MFIs, MIVs, that the amount of equity available is not enough. The amount of equity funds participating in sectors too few. Other factors, poor skills on the part of the MFI. I think that's a factor we can come back to. Profitability being too low. Again, there's issues of scale in the sector. Again, that's a point that we're going to come back to. KYC or compliance issues, I think that's a factor everywhere in the world that, from time to time transactions are rejected for good reason, for KYC reasons or compliance reasons. How can we make MFIs in Africa more attractive to the MIV community as a whole? How can we use innovative instruments which deploy capital to MFIs, benefit MFIs, but at the same time, open the door for other investors, open the door to grow the sector as a whole? So, one instrument which is important, one solution which is important is greater capitalization, greater solvency. So more equity funds, more hybrid capital funds to support the sector. So Verdant Capital Hybrid Fund is designed to fill this gap. Verdant Capital Hybrid Fund is designed to help MFIs increase their capitalization, crowd in more senior debt funding from other sources, and do so in a risk managed way to get a good return, a sustainable return to investors. Having a sustainable return is important. The Good Samaritan did not just have good intentions, he also had money. So we need to deliver a sustainable return to our investors so we can do hybrid 2, and we can do hybrid 3, and we can do hybrid 4. When we started the process of raising hybrid 1, actually there weren't any common equity funds targeting MFI investments in Africa at that time. And it was really, it was almost a wasteland. There was no opportunities for MFIs to raise equity from international sources, from GPs, but some DFIs to a limited extent. As of now, it's good to see that GPs such as Women's World Banking and SureCap are back in the market and providing common equity options, as well as Verdant Capital Hybrid Fund. What else can we do to make MFIs more attractive to invest? Greater scale. Scale is important in terms of costs. Scale is important to give investors the individual investment amounts, debt investors, the individual investment amounts they want. The debt investors want larger transactions. 10 years ago, when we started Verdant Capital, the minimum MFI, the MIVs wanted MFIs to have 5 million of assets or they wouldn't answer the phone. Today it's 10. And 10's too small for almost everyone. So it's almost 20 or 30. So bigger scale, more easy to raise money. It's good to be the best, but it's better to be the biggest. The ecosystem, we can support the ecosystem in terms of initiatives in countries, in terms of credit bureaus, collateral registries. We can support individual institutions with technical assistance. So KfW has been incredibly supportive of Verdant Capital, the Verdant Capital Hybrid Fund, and one way it's supporting is also with technical assistance. Broader access to liquidity is important. So it's very nice to have an investable institution, but nobody wants to be the only investor in that institution. So seeing that the investees have a range of options, including local capital markets, including local bond markets, is very, very important to help crowd in additional capital. Last, but probably the single most important to my mind, currency risk management. The growing range of affordable or realistically priced currency risk management tools for investors and borrowers, critically borrowers as well, is very, very important in terms of broadening the investor base available to an individual MFI. And the broader the investor base available, the easier it is for them to manage their growth. Greater solvency or capitalization. So this is our survey last year. How many MFIs we spoke to? Of the MFIs we spoke to, 3 out of 5 said that they were going to raise capital in 2021. In fact, they said in early 2021. And the bulk of them said they wanted the capital to grow their loan portfolio. So about 3 out of 5 said the capital was to grow their loan portfolios. Candidly, we've not seen a rush of equity deals closing in 2021. So again, notwithstanding the new funds that come back to the market or funds that come back to market, the market is still missing equity capital or equity-like instruments. So there's a big opportunity for funds like Verdant Capital Hybrid Fund, and there's an important role for funds like Verdant Capital Hybrid Fund. What are the capital tools available? I think we've talked enough about senior debt. The senior debt community has grown. There is significant pools of capital available, albeit Africa does seem to be underallocated. It is underallocated. What about capital? Private equity, Private equity is an important instrument. What we would note is over time, private equity with a finite life fund has become more and more similar to hybrid capital. Yeah, particularly as countries move from Basel I, many countries in Africa are still Basel I to Basel II, and countries move from Basel II to Basel III. More and more private equity type investments in financial institutions are actually only deemed to be hybrid capital by the regulators because of exit provisions. The IPO market in the very, very long term, the listed capital markets are the solution to capitalize MFIs in Africa. We've seen that in India. We haven't seen that almost at all in Africa. But if you look globally, capital for big banks in the US and Western Europe and Japan, in all the mature markets, capital comes from the listed capital markets. Can come from the government when banks are bailed out, but in all times other than stress, it's listed equity. So in the very, very long term, if we want to build a vibrant banking sector in Africa, which is well capitalized and capitalized to crowd in debt funding, deposits, and other funding sources, and can grow those economies, grow funding to SMEs, grow funding to large corporates, the very, very long term, it's about listed equity. In the short term, it can take a generation to build a vibrant capital market, a vibrant equity capital market, or 2 generations. So in the meantime, we're looking at the private equity and the hybrid capital. And to some extent, the private equity is converging with the hybrid capital. Greater scale, this point, of course, is linked to capitalization. How do we help MFIs grow their scale? More capital, more M&A. As a firm, we're a big believer in M&A as a way of sharing best practice, building scale, enabling bigger individual ticket sizes into MFIs from lenders, sharing technology, cross-border expansion. We do see an expansion in M&A, partly because of the private equity funds raised 15 years ago and 10 years ago and deployed 10 years ago. Those funds are exiting their investments, and those exits often end up as a consolidation of the sector. Regulation, minimum capital. We're not, as a firm, we're not proponents of central banks just increasing capital to build scale. It can be a very, very blunt tool. Olamide can tell everybody how that blunt tool used by the Central Bank of Nigeria in the middle of the 2000s had a lot of unintended consequences. So we're not big supporters of that. Cross-border growth we see as very important. We see that as a long-term secular trend. 5 years ago, the biggest trading partner for Uganda became Kenya. Until 5 years ago, it was the UK. Cross-border trade, cross-border investment within Africa is very, very low. And if you look at the growth story, which has been delivered over the last 3 generations in Asia, it is very, very important that we promote cross-border consolidation of the financial sector as part of that broader cross-border trade and investment. Finally, greater scale. What else can deliver scale? Well, to some extent, technology. So better adoption of technology, whether that's reducing your cost of risk or reducing your OPEX or finding new markets or new ways to deal with your customers, new products. If you adopt technology successfully, you can grow your MFI, you can be a winner, and that can be a sustainable competitive advantage, which enables you to win against your competitors in the market and grow at their expense, and and effectively consolidate through market share gains. So scale we consider important. It does link back again to capitalization. It does link back then to equity and to hybrid capital. Ralph, if I've got time, I will just very, very quickly mention the capital instruments which Verdant Capital is contributing to the mix with the support of our partners, we are contributing senior equity structures, which can be invested into the deposit taking or prudentially regulated sector as additional tier 1 capital. That's typically a perpetual instrument with a traditional private equity type exit right. And into the unregulated sector, there is a bit more flexibility around redemption of that senior equity instrument. And we're also investing subordinated debt, which in the prudentially regulated sector is structured as a tier 2 instrument. Typically, we're targeting 7 years with a call option on the part of the investee in year 5 to achieve tier 2 capital for most tier 2 capital treatment for most of its life. Again, we're also investing that in the credit only sector, where again we have a bit more flexibility, but structurally very similar, long dated, typically with the investee having a call option or redemption right. We're also looking to invest in holding company instruments, so debt financing into holding companies that can then be pushed down into the operating entities as preference shares or as common equity or instruments that count as capital.
Okay. Thank you, Ed, for your contribution. I think it was okay that we took a little more time. I haven't seen questions so far from anyone, but I would encourage you to do ask questions while you're maybe thinking about it. I have one, Ed. I know that you've been in favor of hybrid capital all along. I mean, since 2018, 2019, and even before that. But how do you think that the latest development in terms of the effect of COVID has maybe even spurred that demand for hybrid capital?
So we try and boil things down to maths at the firm. So apologies if this all sounds very, very mechanical. So the tier 1 MFIs across the continent are delivering ROE of 30%, return on equity of 30%. That means if they're not paying a dividend or just paying a small dividend, they can grow their loan book at 30% per year, and they're not leveraging up their balance sheet. Not many MFIs grow at more than 30%, or some do, and it actually causes them lots of problems. So that top tier of MFI that's bringing capital, bringing debt funding to SMEs, to micro entrepreneurs, doing very well for them and for their customers, can actually grow on a sustainable basis with equity in many cases. What COVID has done over the last 2 years, it's many cases it's wiped out the profits even of the best institutions. So they've got zero this year, or they've got negative, or they've got small profit. But the opportunity to grow their loan book hasn't gone away. The opportunity to grow their loan book is even more, because their competitors haven't done zero ROE, they've done negative. Their competitors are kind of filling in the holes, and they are not making you credit. They're trying to manage liquidity. So there's more opportunity in the market, and customers are restocking. Customers are restocking after COVID, after lockdowns. So you've got more growth for the top institutions, but they've got no capital to support it. So again, this is somewhat anecdotal now, but we've seen a lot of very, very good MFIs, other inclusive financial institutions, who 2 years ago were saying, oh, hybrid capital, that's a great idea. We'll give you a call in a few years when we need your money. The narrative today is, when do you close? When can we start? When's the term sheet coming? And that's not because, any problem in their businesses. These businesses are stable, sustainable. They just, the fuel to grow your MFI is retained earnings. Then you can use that to bring in senior debt. You lost those retained earnings. It's not your fault. You're not going to go bust. You're going to honor your debts, your depositors, but you can't grow anymore. And that's where the Verdant Capital Hybrid Fund is really energized, or really accelerated, or the needs is even more than usual. It doesn't change the story or change the relevance. it just sort of, it's an adrenaline boost.
Okay, thank you, Ed. I think I share that idea that the demand has even grown. Yeah, of course, and it's more relevant than ever to talk about hybrid capital. But I think as well it is really important still, as I mean, TCX has been around for 15 years, but it is still an important issue to talk about currency hedging and what that brings to the market and what that can bring to the market in terms of resilience also. And I'm happy to hand it over to Jerome to share his view on what has TCX done in the recent years and what is there to come in the future. So with that, Jerome, go ahead.
Yeah, okay. I was trying to unmute myself, okay. No, thank you, Ralph, and thank you, Ed. I think I will try to relate to your excellent presentation, Ed, so we can create logical connecting points. And I'm just going to zoom in on the presentation I prepared. So can you all, Ralph, can you confirm you can see it?
Perfect.
Yeah, okay, all right. So yeah, when it comes to TCX, and I know, because I've seen we have only 14 attendees. That would be lovely if the attendees use the chat box so they can ask questions or make remarks. That will make it a bit more interactive. So when it comes to TCX, as you may know, in the microfinance space, we've been instrumental at catalyzing local currency financing. And I think if I refer to your slide, Ed, the reason why, it's mainly because MFIs had the pricing power to pay for the cost of the hedge, and that's also because their business is inherently denominated in local currency, and that type of investor, they're probably the least. They're not in the best position to take the FX risk, to say it simply. So if you look at FX risk, I wanted to make one illustration here. Is FX risk has been a recurrent topic for the last centuries or so. A little bit less, I have to say, over the last few years. If you look at our monthly pricing ledger, where we provide pricing indication on 42 frontier currencies, it's not in that slide, just informing you. We are at the low range, at the low end of the range. So I think, especially in Sub-Saharan Africa, I think the average cost of hedging is closer to 9%. 10 years ago, it was significantly higher. It was around 12, 13%. So that tells you that with tight interest rates and the current macroeconomic environment, the cost of hedging went down. But that's always a risk that comes back to the surface. And the reality is neither us being perceived as the specialist, Ralph, or anybody else for that matter. We can anticipate when it happens. This is why we have a portfolio approach. So we have blips every now and then. I can Argentina the last few years. Nigeria was also quite a glitch in the portfolio of the fund. So these events tend to happen every now and then, and when they do happen, it's quite brutal. So that's the illustration of that side. And I think if you look at the capital structure of MFIs and the fact, as you mentioned, Ed, that NPL is probably a point of attention for a lot of lenders and MFIs alike. Most of them, they're not in a position to support FX risk. And last one example that comes to mind is Azerbaijan in 2016 that experienced a double devaluation, 55%. 55% simply wiped out the financial sector. And MFIs were the first in line. Finca went from probably, I think, $80 million of equity to minus 60 million negative equity in just a few weeks because NPL went up from low to 80%. So you have that obvious transmission mechanism between FX risk and credit risk. So what it means in plain English is where even if you finance MFIs and they don't take any FX risk, but they lend in dollars to clients when currency depreciate steeply, NPLs goes up and the MFI is impaired, although technically that MFI hasn't taken any FX risk. So our mission is to make the balance sheet of MFIs more resilient with benefits to the whole chain, from the lenders to the MFIs to their end clients, to the government, which has a stable source of income and a functioning financial institution. That's important. So in a nutshell, that's what we achieve, and that's summarized in that slide. So let me move on. So a few words on TCX. I'm not going to dwell on those slides too long. So Olamide has time also to share his thoughts on the matter. So our investors and users, this is what makes TCX special, is not only these institutions have provided the $1 billion funding we need to take the FX risk, but they're also active users. So the MFI space, microfinance space, a lot of these names are active finance contributors. Some achievements about the fund. So I think it's here, what's important to share. We've done a lot, especially in the microfinance space. The numbers here are there to tell that story. And these are the markets where we provide hedging solutions. And I think the key message is come to us, challenge us, try TCX out. We make probably any market except countries in war or in deep civil conflicts. But we quote Afghanistan, we quote very difficult markets in Sub-Saharan Africa, and we do it for tenors without any restriction. So in the microfinance space, there isn't really any tenor we won't quote. We could quote 3 to 5 years easy. We can quote even 20 years in some cases. Because, Ralph, that topic is about innovation, right? And Ed made a good demonstration of what it means in this space. I wanted to share the latest innovation in our space, and that's a joint achievement with KfW and the European Commission. Is we have launched a facility that was in June this year. We had 2 windows. First one was in June, the second one in September, where we offered to lenders the possibility to provide local currency funding at a cheaper rate. So the conundrum we try to solve by providing a pricing reduction, which is what you see in that slide, is a typical situation. I'll take Sierra Leone as an example. Olamide, Ed. FX risk is very high, as you can notice. So we price something like 18%. So that's a risk premium to hedge the risk of the leones to depreciate. Credit risk is equally high. I wouldn't be surprised that a debt investor would charge something like 7-8% for credit risk. And MFIs, they're not particularly profitable because that's a very difficult market. NPLs are high, margins are low. I mean, the cost of channeling funds for these MFIs is very high. I'm trying to say operational OPEX are expensive. So you're in this situation where MFIs cannot really pay for local currency financing. And local currency financing is admittedly high. Is it too expensive? I cannot judge. But if you add all the risks, even if you compare with the cost of fund of local banks or where local banks would lend, that's very high. So the exercise here was, okay, how can we close the gap, which we managed to do with that facility? Because in Sierra Leone, we capture close to 10 million of flows, and in many other markets in Africa. So we made this available to the lenders so they could engage with borrowers, the MFIs, on more conducive terms. So that's the second and last slide, where I will quickly walk you through what happened. Is we explain to everyone the terms of engagement. That's the first step, the information period. We created a window where we could collect the interest of the lenders, and we could maximize the use of the grant of the commission. So we created an auction. When you create an auction, you solve a lot of problems like moral hazard, and you create proper alignment of interest amongst everyone. Then we shake the shaker, we rank the allocations, and 4, we started to allocate and when you allocate, then lenders, they do their job. They reached out the Mfis and they start closing the deals. This is what you see all the way up to 7. And this is where we are right now, is we have allocated the full facility and we letting lenders and borrowers negotiate and hopefully come to terms. So in a nutshell, this is what TCX has been doing for the last decade or so, and this is the latest innovation we have brought to the market. On that note, Ralph, I'll give you the floor.
Thank you, Jerome. Well, I haven't seen questions so far in the chat, but I would encourage everyone, also the ones who have joined later, to ask these questions, because I think you've given us a very comprehensive view on what TCX has been doing, also in terms of reducing the price for local currency hedging together with the EU, which is a really innovative feature, I would say. But if I may ask one question with regards also to pricing. Well, that's a repeating topic for you, I know, but I would really like to hear your thoughts on how we can push forward that more projects and more decision makers seize the opportunity and actually use TCX. Oftentimes, I would think that it is not an issue of supply from your side, but rather of demand, and decision makers still look at interest differentials and tend to neglect the fact that higher interest in local currency is in line with the expected inflation and so on. So do you have thoughts what is needed there?
Yeah, I think probably the first step is education. So because the TCX too expensive is a bit the story of my life at TCX. That's something we hear a lot, continuously. So I think the first step is when someone tells you, Ralph, your product is too expensive. I think the first step is to understand what are the reference points that person has in mind. I would say in the US or in the EU, any borrower will go through that step. They'd say, okay, where is my government borrowing money? Where are the blue chips companies in my country borrowing funds? Where is the prime lending rate that the banks in my country are offering? Where do I fit? If I'm a small enterprise, I know that if Siemens in Germany is borrowing at German bonds plus 50 basis points, I mean, it seems totally reasonable that probably I get my funding at government bonds plus 300 basis points. Or if I'm a high yield company, maybe 500 basis points. So what we're trying to do, and this is what we do in our webinars consistently, is to make the demonstration, where is our pricing and the pricing of investors that we hedge. That could be a debt fund, Ed, or anybody else for that matter, any microfinance MIV investor. We want to compare the cost of fund of the TCX solution, I will call it like that, with other solutions. So the local banks, Ralph, naturally comes as a first point of reference, then the government. So we create that cloud of points to set points of reference. And then this is where the discussion is getting more dynamic, is when you've done that exercise, then I think you can assess and make these type of claims of statement, whether we are more or less expensive. And quite often, when we do that exercise, people realize that actually we're competitive. But what happens is they're not willing to pay the cost for the extension or duration. So a lot of investors, they focalize their attention on the 1 year point, as an example, where they pay X. We tend to offer 3 to 5 year debt financing solutions. And you realize that generally we're 1% higher than the 1 year point. And a lot of investors, they're not willing to pay that premium to secure longer term funding. So a long story short, I would say education is a second point. And the second point, if you look at the result of TCX, that's also the demonstration that on average, we're not taking advantage of our monopolistic situation, is our return is closer to LIBOR plus 1.8%. So if we would overcharge consistently investors and their end clients, we would make 10% per annum, not 1.8. So that tells you that on average, we almost price to perfection. And that's important that people realize that, because if your insurance company is making very small returns because they are socializing the premium to maximize access to their members, then you know that the premium you pay is right. If they make a hefty profit and they invite everyone to the Caribbean for Halloween, then you know that there is something wrong with the price you pay for the instrument.
Okay, thank you very much, Jerome. I know we are a bit short on time, but I think we can spend at least 10 minutes for you, Olamide, and the ALCB fund, and then make the wrap up a bit shorter, because I think what has been said already has been very comprehensive to everyone. So I, without further ado, Olamide, go ahead with your input and contribution, and thank you very much, Jerome.
Great. Thank you very much, Ralph, Jerome, and Ed. I think I will quickly run through a few slides, but they sort of relate very well to the broader discussion, and in particular, you know, with TCX, the advantage of that institution has enabled one of the initiatives that Lion's Head manages, which is called the African Local Currency Bond Fund. I'll quickly sort of run through and describe the mission and the strategy, and then maybe talk through a few case studies of specific experience that we've had in Nigeria and an initiative that we're trying to promote. Fundamentally, the fund does what the name suggests, and invests in local currency corporate bond issuances across sub-Saharan Africa. The mandate is really to promote development of the local currency capital markets by bringing first-time issuers in high-impact sectors, and supporting and enabling them to raise domestic institutional local currency capital, which we view as, in the long term, you know, if not the most, a very sustainable source of financing. The way that the fund works is that we can act as an anchor investor, i.e. engage with issuers early on, and you know, having gone through our credit process, we have the ability to take a sort of, you know, 30% anchor position in a potential bond issuance, which obviously supports engagement as you're going out to market for you know, the balance of the funding, while you have a core investor that's ready to support and promote the issuance. We aim to price alongside local investors. We obviously have a hurdle rate that we're looking to achieve, but fundamentally, the mandate of the fund is to, as much as possible, act as a domestic investor in the market, and price accordingly. So there have been instances where you know, it ends up that, you know, having gone through our DD and our credit process, we're fundamentally not needed, because the local market is willing to take up the book at a price that either doesn't work for us, but it also demonstrates the fact that there is sufficient demand within the market, and we're not looking to crowd out those investors. Our targets, again, are, so, you know, first-time issuers who need the support, sectors of which the MFI sector has historically been a core of what we're trying to support and promote, and then innovative or within the local market, innovative instruments that are sort of enablers to broader capital market engagement. So I'll quickly run through. So our portfolio, you know, covers about 18 different countries. We've invested in about 45 different institutions. And as you can see from the sector breakdown, micro lending and MSME finance has been a core of what we're, of the types of institutions that we try to support and engage with. So just, I guess, given time, I will maybe delve a little bit deeper into a couple of case studies. So we engaged very early on in Nigeria with an institution called Lapo Microfinance. It's the largest microfinance bank in the country. Has been well supported by a number of international institutions, and is a I guess fundamentally a well-run institution in the market. We spent a sort of period of roughly two years engaging with them to support a potential bond issuance. At the time that we started the engagement, it was in one of those periods that I think Jerome mentioned of FX, let's call it dislocation in Nigeria, where you have a combination of the depreciation, but also the convertibility issue, which contributes to the perfect storm. So they did have funding lines from some dollar funding lines, some hedge dollar funding lines, but fundamentally part of their challenge had been around access to FX to make payments on those facilities. So there was a challenge that they were facing there. They've since resolved that, but we helped that institution to engage with local counterparties, register a bond program, and we supported them as they came to market for the first time. The first issuance that they did fundamentally was less successful than we would have wanted to be, which for us means that we were more of that overall issuance than we would have liked, i.e. there wasn't sufficient local investor demand. Part of what we did after that first transaction was really to attempt to engage the market and engage investors that had looked at the transaction, but to understand what the challenges were what they felt the challenges were in supporting that institution. Because if you sort of benchmark it independently against some of the other commercial banks in the market that are typically well supported, from that perspective, LAPO stands out well and is a credit-worthy institution to support. So some of it comes down to negative perceptions around the sector, around the market, and things like that. But more fundamentally, I think, was just a lack of familiarity with the business itself. Move forward sort of 3 years later, LAPO came back to market for a second time. So early last year, just before the sort of COVID impact. So it was a pretty well-timed issuance. And having had a track record of being in the market, of being a good payer and performing relatively well over that period, they were able to issue a second time and have their book more or less fully filled by the local market, where the ALCB in that particular instance was just a much smaller proportion of the overall issuance. So I think that's the kind of engagement that we have within the sector and what we're trying to promote as a fund acting in the market. And again, the way that we operate can only be done with the support of the likes of TCX, who enable us to hedge sufficiently well to act like a local investor in the market. Maybe I'll just quickly touch on one additional initiative. So we have a technical assistance fund that is really designed to offset some of the cost of issuance, to remove some of the friction that we do see with first-time issuers in establishing a bond program. The other part of what that facility can do is to work with local counterparties to develop structures that we think are needed in the market or can promote further issuance. And in Nigeria, one of the initiatives that we are working on with DLM Capital is essentially a wholesale microfinance funding vehicle that will raise funding in the market and on-lend them to the broader sector. Part of the challenge in Nigeria in particular is you have the top 5 institutions are at sufficient scale, then you have a long tail of smaller institutions that to varying degrees are well capitalized and sort of profitable institutions, but fundamentally lack the scale standalone to go out to the market to raise funding for themselves. So, and we've engaged with a whole number of them and working through the process of trying to raise that institutional capital. So what we're trying to achieve with this vehicle is to aggregate enough scale. I think Ed talked about the lack of scale quite a lot in his presentation, is to aggregate enough scale to allow capital markets funding to go through to the rest of the sector. So I'll stop there and maybe happy to take questions.
Thank you. Allow me the very resourceful, very helpful, and you covered also the questions that I would have had with regards to success factors, because you illustrated quite nicely what is important if you bring new products to the market. Is there anything that any of you want to contribute before we wrap this up? Ed, Jerome, Olamide, or anybody from the audience? No, I'm not hearing anyone. So thank you very much, Jerome, Olamide, and Ed. I think it's been very, very nice to have you on the panel here, and all blended in perfectly. The instruments that we presented today, I mean, the instruments that you and your companies represent are perfect examples of what we need in the market to make it more resilient. And we're not reinventing the finance industry here. I think that's the key message. But those innovations need to be brought to all markets, and we need scale. Yeah, we had that issue as well. And with that being said, let's push this forward and have a successful future together for all our customers and clients and partners in the market. So thank you very much.